Thanks a lot. It's a big honor to talk here in honor of Raghu. And Raghu is a person you can only look up to, and it's a big pleasure to be here. I will talk today about financial dominance, but more broadly, it's about banking, short-term debt, and monetary policy, all areas where Raghu made major contributions and has shaped the thinking of the whole profession, and of course also my thinking. So let me talk about financial dominance, which my thinking also, of course, is shaped by my co-author, Yuli Sannikov, on this matter. What's financial dominance? There's the term fiscal dominance, which is essentially comes from the fiscal theory of the price level, which says it might be impossible for the central bank to raise interest rates if needed, if the fiscal authorities, i.e. the governments, refuse to cut their spending. And that's essentially, at some point, the monetary authorities might be caught in such a situation and then cannot raise interest rates to counteract that. Is there something similar on the financial side, something like financial dominance? Can it be that it is impossible to raise the interest rates because when you were to raise the interest rate, you would drive the financial sector into difficulties? And why is this impossible? Because they refuse to raise new equity, or they have just paid out high dividends before the crisis in order to get the money out. You can also see it from the other side. You might say, from a banker's perspective, it might be dangerous to have too much equity in the times of crisis. In times of crisis, you always have some losses to be shifted around. Somebody has to eat these losses. And if you have some extra equity sitting around, the losses might be shifted onto you. So essentially, it is a strength to be weak because nobody can shift losses onto you. It might be a strategic defense mechanism to be vulnerable in order to avoid being taken advantage of, in order to have some financial repression going on. So let me just elaborate on this thought a little bit further in this speech here. As I mentioned, whenever there's a financial crisis, there are some solvency losses, some debt overhang problems which you have to deal with, and you can only deal with them by absorbing these losses or redistributing these losses. And on the other hand, you also have liquidity problems. How can you absorb these losses? You can do it through the fiscal authorities, through bailouts by taxpayers. You can do it through the monetary authorities, through surprise inflation or financial repressions, essentially pushing the losses to nominal claim holders. Or you can also do it to the bondholders by defaulting on the bonds. But essentially, if there are losses there, somebody has to eat these losses, and the question is who will eat them and how do you distribute them? Of course, not everything is about losses. Losses can be self-generated. A lot of this is also about liquidity. If you deal with liquidity problems early on very aggressively, you can avoid that the liquidity problem morphs into a solvency problem. So who is dealing with liquidity risk that suddenly you can't roll over your debt? And that comes to the short-term debt nature Raghu has worked so much about with Doug on banking and also monetary economics, and I will talk more about this in a minute. So there are two ways you can deal with that. You can have a setting, you have an economy where the government is issuing a lot of short-term debt, and then the fiscal authorities, the governments, are subject to rollover risk. Every month, the government has to roll over its short-term debt, and suddenly it might not be able to roll it over. So the government is taking on this liquidity risk. You can also have a situation where the government is issuing long-term debt, and the banks buy this long-term debt, and then the banks issue the short-term debt. Okay? Essentially, that's what banks do. They essentially do the liquidity transformation, maturity transformation in this case. Now, essentially what the banking sector is doing, the banking sector is taking on this liquidity risk from the government, and the government is not facing this rollover risk anymore, but now the banks face this rollover risk. And that's also where Raghu's work comes in, that actually it might be good for banks to have short-term debt because it disciplines the bankers not abusing their power from running these banks. So bank runs, or the potential threat of a bank run, is a disciplinary device. Here I would like to focus on a different thing. Who should hold this liquidity risk, this rollover risk? The government, or should it outsourced to the banking sector, where the banks buy long-term debt, get a higher interest rate on it, long-term interest rate is typically higher, and issue short-term demand deposits. Now you might say, who is then bearing this interest rate risk when the interest rate suddenly goes up and this rollover risk associated with that? Then depends, as I said, very much on the maturity of the government bonds and on the risk-bearing capacity of the banking sector. What sense does it make to buy some insurance from the banking sector if the banking sector has no equity to provide this insurance? So if the government issues long-term bonds and the financial sector transforms its maturity and the banking sector is well capitalized, then everything is fine. The banking sector is providing a service, it provides this liquidity insurance, and in return it gets the term spread. But if the banking sector is undercapitalized and cannot take on this risk anyway and will fall back to the government sector later on, then offering the service as maturity transformation is purely a transfer of funds. And these are the two things I would like to play off in this talk. So they essentially put it differently, who is insuring whom against liquidity risk? And there's a dual role for default-free long-term government debt. I will focus first on default-free government debt, and later on in the talk I will introduce default in government debt, coming to diabolic loops and other phenomena we see very much in Europe. So one view is the banks insure the government against this liquidity risk, and the government is, or the fiscal authorities are insured. But what happens if the banks are undercapitalized? The other view is, the government is insuring the banks. The monetary authorities, the central banks are insuring the banks against liquidity risk. That's very much in my work in the I theory, where monetary policy redistributive, where you try, whenever the banking sector is in trouble, you cut the interest rate. By cutting the interest rate, you raise the value of long-term bonds, and this way you recapitalize the banks. So interest rate policy is about recapitalizing banks. And also open market operations, of course, or if you buy outright some assets which is on the balance sheets of these banks. So monetary policy is very much getting rid of some debt overhang problems and impaired balance sheets. So let me go into this theory a little bit close in the I theory and show what actually is going on in some pictures. So let's start with a very simple economy. There are some savers, there are some end borrowers. These end borrowers might be households. They want to buy some houses, mortgages, they need mortgages, or there might be firms trying to run some enterprises. And in a world without banks, if you're a saver, you have extra funds, you have saved for your retirement, you can just lend it to some end borrower. The assumption is that you can lend it to your friend, but you can't really diversify across the end borrowers. Or you can hold your funds in terms of outside money, money which is provided by the government and backed by some tax revenue. That's a world without banks. Once I introduce banks in this economy, then there's, instead of this direct lending, or in addition to this direct lending, you have this indirect lending, and the banks have some advantages. First, the banks can diversify across all these end borrowers. By diversifying, it's less risky. And they also have better enforcement technology, better monitoring technology, so banks are actually better lenders, like in many of Raghu's work. And the banks, what they do is they give loans, credit to the end borrowers, and they issue inside money, demand deposits, and other forms of short-term debt. And of course, there is also an equity cushion, so the bankers themselves have an equity cushion, and it's important that there is some skin in the game for the bankers in order to do the enforcement, the monitoring, and diversification the right way. So in such an economy, a very simple, stylized economy, I would like to analyze what happens if there's a negative shock to the end borrowers. Suddenly the end borrowers are not able to pay back as much as they're promised to pay back. And I would like to split up the shock into 4 steps in order to really highlight what happens in such an economy. Notice I have not introduced any long-term bonds yet. I will introduce the long-term bonds later on. So the first thing what happens is there is an impairment of the assets of the banks, so the assets lose some value. Of course, the inside money is not going down, so everything has to be absorbed by the equity. So the equity is going down,
And let's suppose the credit or the loans went down by 5%. Equity, because the banks are levered, might have gone down by 50%. Okay? So equity was going down much more in percentage terms than the loans. This means the leverage ratio of this bank after the shock went up dramatically. So what's the response of this bank? So, oh my God, the bank says, I'm so levered now, I have to delever, I have to sell off some assets. So the banks will actually sell off these assets. And by selling off, they shrink their balance sheet. And that's what you observe in any of these crises. You see a shrinkage of balance sheets. Where do you sell these loans to? To other banks? The other banks don't, they want to sell off too. All the banks would like to sell. The only one you can replace is indirect lending with direct lending, which is less efficient because the savers lending directly to end borrowers, they cannot enforce the loans as well as the banks can. So what's happening, because you have to sell it off to somebody who is not as well equipped to handle these loans and give loans, there will be a fire sale price. The price will go down, and that leads essentially to losses, further losses. The value of the loans will go down, and since the inside money is not going down, equity will shrink even further. And that's a self-defeating mechanism of deleveraging we have seen so much. This was the third step. First step, negative shock. Second step was we had a shrinkage of balance sheets. That led to the asset price decline, the liquidity spiral kicking in, and you have the equities eroding even further. Now the fourth step is, you notice by shrinking the balance sheets, the total money in the economy was shrinking too. The amount of inside money created by the banking sector was going down. What does it mean if the total money supply is shrinking? Outside money created by the central bank is still there, but the money created by the banking sector is shrinking. This means there's deflationary pressure. Deflation is kicking in. Inflation is going down, it might even go to negative territory. This means the real value of the money is going up compared to expectations, for sure. This means that actually the bankers suffer again, because for them money is on the liability side. For the saver it's an asset, but for the bankers it's on the liability side, which hits the equity again. So all of these four effects, they just reinforce each other and make a small shock much, much larger. Okay? So that's in a world where we have no monetary policy. I've switched off total monetary policy. Outside money supply is just fixed. That's like pretty much on the gold standard. You can think of the Great Depression, what was going on. Essentially, the banks are hit on both sides of the balance sheets. First on the asset side, then they try to shrink their balance sheet, and there will be the liquidity spiral that hits them on the asset side even further, leading to financial instability. But because of that, total inside money creation is shrinking as well. This leads to deflationary pressure. This leads to price instability in form of deflation. So the response, it is actually the response of the banks which makes it so bad. If the bankers would have said the negative shock, we just hold on to it and don't shrink it, you wouldn't have this deflationary pressure kicking in. So the response is what caused the amplification and the persistence and endogenously generated systemic risk in this economy. And what's key is there's a huge wealth distribution from the highly levered banks to less levered ones. And this can be for the banking sector, for any levered sector. It can be for the corporate sector, as it was the case in the 1980s or early 1990s in Japan, or for the household sector, as it is right now in the United States. So all of this asks for some intervention, and I haven't introduced any monetary policy yet. That's where now monetary policy comes in. The role of monetary policy after this passive behavior of these hugely impaired balance sheets is to actually reduce this amplification. It only should be focused on the amplification part and the endogenous risk on this. And there are different views how you can reduce this amplification. And I would like to contrast from the literature the money view and the credit view. And the money view, what I characterize, is an aspect where you try to fix the liability side of the banking sector and try to stop the deflationary pressure. And the credit view goes even further. You would like to restore credit flow to the real economy. So let me show you the money view first. So the money view, think of a hypothetical example, a helicopter drop of money. And the helicopter drop is actually not going to the banks,
not to the bankers, it's actually going to the savers. Okay, they get all the money. Who is winning from that? The savers, they will just bring this extra money to the banks, and the banks will have extra reserves. But who is really winning from this helicopter drop are not the savers who will collect this money, because it will, through inflation, go away. The guys who will really win from this are the bankers, because less deflation or high inflation helps the guys who have debt. And who is debt are the bankers. So the bankers benefit from that. So by restoring the lack of inside money, like in the Great Depression in the United States, where inside money was shrinking, you replace it with outside money. That's what Friedman and Schwartz essentially said. That's how you can switch off this deflationary spiral, and the bankers are better capitalized by doing so, and slightly more credit. In contrast, the literature on the credit view says, let's not drop the money to the savers, let's give it to healthy banks. Not zombie banks, which are undercapitalized and thus gamble for resurrections, and also not to vampire banks, which are banks which suck out demand deposits from other banks, which pay a high interest rate like 4.5% in some parts of Europe, where others pay 0% on demand deposits. Let's give it to healthy banks, and by doing so, you essentially give the bankers a gift, and by giving them a gift, they will be recapitalized, and everything goes back to the old world where they give credit again to the real economy, and the real economy can be started again. So this is a little bit crazy, you might say. That's essentially giving the bankers a gift, and then in order to restart the economy, and we call it a stealth recapitalization of banks through monetary policy. And this doesn't occur so obviously. I mean, the way I presented it here is very blunt, and you see it right away, just dropping money on somebody. What you really do, you do it in a more subtle way. Monetary policy acts in more subtle ways. You do it through outright purchase of bank loans or interest rate policy. And in order to show this, I need this long-term bond I was talking about initially. So let's look at a little bit more complete bank's balance sheet by introducing long-term government bonds. And let's suppose these government bonds are default-free. There's no default on it. Government bonds pay 5% fixed interest rates, and they're held by banks. And you will see in a formal model, in equilibrium, they like to hold these bonds. Essentially what's going on is, now we do the same negative shock on the credit, so suddenly credit shrinks. So we have an adverse shock, and the whole mechanism we have just described would kick in. But what now the monetary authorities do, or the central bank do, they cut the short-term interest rate, and by cutting the short-term interest rate, the value of the long-term bond is shooting up. Okay? They can also buy some long-term bond in order to increase the value of the long-term bond. So essentially, you increase the value of the long-term bond. And by doing this, you stabilize the economy, you switch off all these amplification effects I was talking about earlier, but essentially you're also granting a gift to the bankers. Okay. Now, is this a bad thing to grant a gift to the bankers? You might say ex post, monetary policy is very redistributive in a sense that, you just give the bankers extra money, but you start the economy again. So it's not a zero-sum game. More importantly, if you view it from an ex-ante perspective, you should say whenever there's a negative shock and the banker would suffer from this amplification and all that, you help them out. Whenever there's a positive shock, you hike the interest rate and take it away. So in a sense, monetary policy is not granting gifts. It's like giving gifts in crisis and taking things away and taxing in good times. It's essentially an insurance scheme. So banks, monetary policy rules, ex-ante monetary policy rules, is an insurance scheme for bankers' balance sheet in order to avoid some debt overhang problems, impaired balance sheets on the banking sector. Now, like any insurance scheme, insurance will involve moral hazard. If you know whenever there's a negative shock, this Fed or whatever, the central bank will cut the interest rate in order to bail you out, then you will be less careful. There's moral hazard. And that's why it's so important to have good bank regulation going on, micropotential and macropotential, in order to make sure to control this moral hazard associated with this monetary policy, which you need. If you don't do this monetary policy, you end up something like the Great Depression. Now let me put the picture a little bit more closely together. So what I said so far is we have financial stability. It's very important to have bank regulation, and price stability is closely interacted. Traditionally, before the crisis, people thought we have three stability concepts: financial stability, price stability, and fiscal debt sustainability, and we can treat them separately. But now we notice that they're all highly interacted. We can't just say financial stability is a job for the financial regulators, price stability for the central banks, and fiscal debt sustainability is a task of the governments. They're all interconnected. There has to be coordination, and they have to play together with each other. So we talked about the liquidity spiral and causing the financial stability. I talked the Fisher deflation spiral linking financial stability and price stability. Now I would like to introduce fiscal debt sustainability issues. And for this I need, again, a government bond, and the potential of a default in government bonds. So far, it was just monetary policy works very well to use long-term government bonds to do this redistribution. No? But I assume the long-term government bond is default-free. Now let's assume, let's relax this assumption and say, oh, the long-term bond might actually default. So what happens if there's a negative shock? So when there's a negative shock, so now, let me jump to the next slide. So when there's a negative shock, then credit will go down. Because credit is going down, GDP is going down, tax revenue is going down, the government is actually less balanced. And now you have these two dominance regimes I will refer to later on. You have monetary dominance and fiscal dominance. If the fiscal authorities refuse to balance the budget in the long run, not short run, but long run, if they refuse to do that, and if that's fiscal dominance, if the monetary authorities refuse to accommodate what's going on, that's monetary dominance. If the two are stubborn, then the only outcome is default of the government bonds. So the government bonds will default, which will hurt the banks again, and you have this diabolic loop going on. The banks will be hurt even more, GDP drops more, tax revenue goes down, and the bonds will be even more risky. Okay? So you have this diabolic loop going on between the financial stability and the fiscal debt sustainability kicking in. Now you might say, one guy will blink. Of course, what would help is if the banks are better capitalized, you can just push on this problem, not on the monetary side and not on the fiscal side, you push it onto the banks. But there's, of course, also financial dominance, making sure that the banks are not sufficiently capitalized, so you can't just push the problem onto the bank's balance sheet. Now, let's suppose the monetary authority says, if we let this go, anyway, there will be this Fisher deflation, there's huge deflationary pressure going on, so the monetary authorities will blink. And if you have only fiscal dominance but not monetary dominance, you have a second force, you have the inflationary force. So what you have in times of crisis, you have the strong, powerful deflationary force, but you also have the strong, powerful inflationary force. Both forces opposing each other. Okay? And these two forces opposing each other are very difficult to balance. So the system is very unforgiving towards small mistakes. And the whole problem is like riding a bike. When the bike, you ride at a certain speed, it goes very well. You can balance it very well. If the economy slows down, then you want to balance it. You don't know where the bike is falling, left or right. So you don't know, is it going to the deflationary mode or is it going to the inflationary mode? So it will be much more difficult to balance. And that also explains why people have such different opinions. Some people say, oh my God, we go totally deflationary mode. Others think we're going inflationary mode because the expectations are so different because we don't really know which way the bike is falling. And this, once you don't know which way the bike is falling, there's inflation uncertainty, and of course, this uncertainty will give rise for a risk premium, which is also bad for the economy because long-term bonds will have to carry a higher yield just for the inflation uncertainty. So what does this call for? This calls for, of course, to avoid any crisis. This calls for preventative monetary policy, early warning signals, credit growth, imbalances, has to be monitored. This has to be taken into account. One has to be aware of the fact whenever volatility is low, that's exactly when systemic risk is building up, and that's when you have to be very vigilant in terms of monetary policy. Whenever you have financial innovation That's an indication something might be going on. And it's also a call for that typically when you have an imbalance building up, price aspects don't really work. Quantity aspects really work. If you look at the Japanese problems, it was the total volume control which really brought the bubble down. It was not the interest rate hike. It was similar in the Great Depression. It's always something like LTV ratios, something which works on the quantity of credit, which has way more bite than the price. So let me conclude and come back to Raghu. And all of that, what I said so far, there was only short-term debt, except for the government who had this long-term debt. All of this amplification is to a large extent because of short-term debt. And for this, it amplifies, leads to liquidity problems, and you need monetary policies essentially intervening there, acting as lender of last resort or any other support for the banking sector. Essentially, ex-post monetary policy redistributes wealth whenever there's a crisis, and whenever there's the banking sector or any other sector in troubles. You look around, you essentially have a monetary policy that where's the bottleneck? Which sector suffers from impaired balance sheets? And how do I redistribute wealth into this sector in order to get rid of the impaired balance sheets, in order to get rid of the debt overhang problem? If not, things get even way worse. That's ex-post intervention. Ex-ante, it's an insurance scheme. I know whenever some sector gets into trouble, I will help the sector out. The financial sector is always part of this game. And this comes with moral hazard. So I have to control this ex-ante, and the moral hazard aspects are very, very important. So who is insuring whom? If you have this view, it's very much the government sector insuring the financial sector, insuring against liquidity runs. And it is not the banking sector insuring the government against runs. Of course, it depends on the country, and it depends how well the banking sector is capitalized, whether they can really provide effective insurance or they just provide some empty insurance against that. So you can think of being undercapitalized as a bank as a mechanism, a defensive mechanism to avoid financial repression, or that losses are pushed onto you. I'm just too weak to carry these losses, and I'm strategically too weak. And that's why also what we saw in 2007, we saw huge dividend payouts by the banking sector. Overall, all these three stability concepts are highly interlinked, and Raghu has worked on all of them and has probably developed a wealth of knowledge, or has developed a wealth of knowledge, will be extremely helpful to deal in the financial crisis and also what's going on in India right now. And at the end of the day, in a recession or in a financial crisis, you have these two opposing forces. You have the fiscal deflationary force, but you also have the inflationary force, and they're very difficult to balance. And that's why you would like to have a monetary policy framework and a macroprudential framework which avoids getting close to this, where you can't control things anymore based on small mistakes. Again, congratulations, Raghu, for all your inspiration you gave to a whole generation of economists, including me, especially me, looking up to your achievements and to you as a person as well. Thank you.
Thank you very much, Markus, for this very interesting view on monetary policy as an insurance scheme, and also stressing very clearly the high degree of interaction between financial stability, fiscal stability, and price stability, which really came across the recent years and what we have observed there. I also found very interesting the opposing effects you have mentioned with the bikes on inflationary and deflationary pressure, and I think there was a lot of food for thought and also a lot of challenges in your talk, so I guess there are quite a number of questions from the floor, and I'm ready to take them now. Yeah, Bob? Oh, maybe you just wait for the micro then.
Thank you. Robert Merton. Thank you for your talk. But I had two very specific questions, and I don't know how large they are, but I think they could be, particularly in the kind of crisis we had. it still seems that a large part of what you're talking about is closer to illiquidity than insolvency. And in particular, what I have in mind is when the assets actually fall, as they did, both corporate and housing and real estate, the risks of individual loans actually go up per unit. So even if the banks had zero leverage, fully equity, their assets become, the same assets become considerably more risky because of convexity. And so I don't know how that fits in, but you can't just look at the leverage ratio because the risk of the assets have changed dramatically in that context. So that's one of the questions. The second is that you mentioned in the inflationary parts. Do you have any observations that since we do have in many countries, and certainly in the United States, tips of all maturities, can you identify which parts are from the inflationary and the nominal? And do you see in the data support for your hypotheses about what the uncertainty about inflation deflation?
Yes, thanks a lot. So concerning the first question, I totally agree. So the model we have doesn't incorporate this, that the assets become more risky, but it's very much along the lines that operational leverage would work. So there is essentially, of course, many assets themselves have leverage built in. So you would also get this, and you have physical assets which have operational leverage, which would also amplify and work exactly the way you indicated. In terms of the second question, so there are some studies who don't use tips, but they use inflation products, option products, and they back out implied CDF or the risk neutral probability from inflation products, and they see that there is a much more spread out. There are some guys who have think the inflation will be high, and others think the deflation will be high. So Bank of England has some study on that, where you can look at the expectations of the inflation and how it varies over time, looking at these inflation products traded. I mean, they're not so liquid, but you can back out a whole distribution rather than just have a single expectation number.
Any further questions? Oh. Okay. Thanks.
I have a question about the risk on the balance sheet of the banks, and most of the assets which are on the balance sheet are usually government bonds, and they are zero risk weighted. And I think it won't change in the next future, even in Basel III. So do you have any idea that we can skip the systematic risk on that one?
Yes. So that's indeed a problem in Europe, that there's no risk associated with any government bonds. That's, on the other hand, you also need a safe asset when you want to delever to go into something. So you also have to have some safe asset in the economy. So what a group of us have proposed at something is this European safe bond, where you would pool all of the sovereigns in Europe and then develop a safe senior bond and a less safe junior bond, and the safe senior bond would then have the zero weight, risk weight, safe nature you need in order for a banking sector to function. So that's indeed, I think on the one hand, it's not good to have no risk reflection at all in the banking balance sheet. On the other hand, you need a safe asset for the banking sector to function. And there are some ways one can generate safe assets by being a little bit more creative in doing so. And this would also help very much the capital flows within Europe. So whenever the crisis becomes more severe, you see all the capital, the flight to safety going into Germany, and then when the crisis goes away again, then the capital is flowing out again. So to switch off this capital flow, which are purely flight to safety capital flow, you can design a portfolio of all European sovereigns, have a senior bond and a junior bond, and the flight to safety capital flows will then be from the junior bond to the senior bonds, and both bonds are European bonds. So this would stabilize automatically the spreads you have faced in Europe, where to some extent they're all driven by a flight to safety phenomena, and not necessarily only about the default risk. So you would like to focus the difference in the spreads only by default risk rather than flight to safety phenomena.
Yeah, I have two questions. One in part you answered here, but the model, the way I see it, is just of one sovereign and one central bank. In Europe, of course, we have one central bank and many sovereigns. So how does the model change when you introduce that? In particular, do the banks have any incentives to try to stay away from their own sovereign, or is the political system forcing them to buy their own sovereign? So how does it work? And of course, once you have a redistribution, you add not only the redistribution from sort of taxpayers to banks, but also from north to south or south to north, is very politically charged. The second point, which I think is the neatest implication of this model, is we have a macro literature that for 20 or 30 years insisted very heavily about the independence of the central banker from the political system. And all this is basically, in the language of your model, focused on the fiscal dominance. However, you pointed out very correctly, there is a flip side of that, and is the financial dominance. And from your model, it seems that it is as big a risk for the central bankers to be captured by the financial system and the banks than to be captured by the political system. So the independence from the banking sector is at least as important as the independence from the political system. But not only the literature has, in my view, completely ignored this aspect, but also the practice has ignored this aspect. In the sense, in the United States, not to speak poorly of the ECB since you are in Frankfurt, but in the United States, the Federal Reserve of New York board is appointed by bankers, and the head of the New York Fed is a representative of the banks. So don't you think that there is kind of a contradiction here?
Okay, thanks, Luigi. I think both questions are dealing with the game of chicken. One is a game of chicken between the fiscal authorities and the monetary authorities, and the other one is essentially, once you have 17 fiscal authorities, then it's even more, they're playing game of chicken among themselves. So there's a lot of things going on. Multidimensional. So my philosophy is, let's first understand one country, and then we can move to the next stage where you can then include this. But it's definitely the case that there are huge redistributional issues involved, and one has to think about them carefully. There are also different interests aligned that way. And I think the biggest problem is that there is always this war of attrition game essentially going on. There are certain losses which have to be assumed either by the central bank or one of the 17 fiscal authorities or the banking sector. And nobody wants to assume these losses, so we just wait and carry it on. And over time, the losses become bigger and bigger. The economy slows down further and further because there's no clear resolution. And everybody is like the famous war of attrition, where you go, two cars going against each other, and then a hit, and who turns out will win, and they will essentially crash at the end of the day. And nobody wants to really sit down and say, okay, let's coordinate and let's find a solution for this, rather than just wait and make the situation worse. Concerning the independence of the central bank, I totally agree. So we have to rethink a little bit what independence means also with respect to the financial sector. I think what's very important is that the central bank is not at the end pushed by others to assume the losses, and then this leads to inflationary problems. So it's also important how to design the trigger, who is allowed to close down banks. Is the central bank also part of the game? Can the central bank decide, okay, this bank needs to be closed down, or is it only some fiscal authority who is very reluctant to close it down because the losses might end up with the monetary authority? So the question, when to close down banks, who is the trigger of this? And then, of course, all the board members association, that's even more problematic. But the design of the trigger, which is a big debate right now in Europe, I think is very important. I think a multiple trigger world is probably a better world where nobody can veto, and many authorities, be it the fiscal authority, considering the tax income revenue, and considering the monetary authority, both can trigger the closure of a bank early on rather than dragging it on.
Okay, since we are running a little bit behind schedule, if there are no further urgent questions, I would rather prefer to move on